Hi, Dominique, and welcome to another key events and week ahead. Um, this week, like most weeks this year, have been pretty exciting. So first, maybe let's kind of dive into your kind of thoughts on the events and market reactions to this past week.
Sure. Well, Jackson Hole, everybody was very anxious, myself included, in part because I was with the consensus, and that always makes me a little anxious about possible dovish pivot, which wouldn't have made sense from a macro perspective, from an economic perspective. But Powell, was hawkish in tone. He talked about imposing some pain on the household and businesses. He sounded very Churchillian about blood, tears, whatever.
Right.
Basically, nasty things are coming, and as a country, we need to stand up to these nasty things because there is no other way. So everybody marveled at how hawkish he was, but look at the pricing of the Fed funds rate. I mean, we still have cuts priced next year. And so why do we have such a discrepancy between the tone and what the market takes out of the words and the tone of our chair? I think it's basically a lack of credibility, and to me the lack of credibility comes from a macroeconomic scenario which is completely unrealistic. You have only a limited increase in the Fed funds rate. The Fed funds rate is deeply negative this year, and yet the Fed believes that would be enough to bring inflation back to close to target next year. And that happens with 20 basis point increase in the unemployment rate, both next year and in 2024, which is a joke, frankly. So there is that. And also people don't have as short memories as the Fed expects, because, was it just two years ago, right? The summer of 2020 is when the Fed unveiled its new framework, which was intended to prevent inflation from falling persistently below the 2%. So I think this was based on the idea that the Fed had much more influence on the inflation rate than it actually had. But it was profoundly dovish. And I think people haven't forgotten that the Fed, even a year and a half ago, was very dovish. And that's probably another reason why Chair Powell talk tough, but the market doesn't listen much.
I was saying, like, Neil Kashkari is an example. 1 year ago, and then from my recollection, pretty much his entire time at the Fed, he's been super dovish and in many ways supported all these potential bubbles that are there. And now he's, talking super hawkish. And I think, one, it's also confusing, which the markets don't like. Definitely interesting. But as we agree, they probably did a bad job prior to, the issues with pandemic. But obviously, some of the things, pandemic, the Russian invasion, things like that, no one's going to predict that. So, how do you think so generally you're looking at the fact that there's cuts priced next year, but the overall levels have gone up. The overall yields have gone up since Jackson Hole, which I guess is what their intention. And and then what's your interpretation of the recent data? you definitely have been, let's just say you've been right that the data has been bouncing back a lot, where most people were calling saying this is the beginning of a deep recession, which so far in the last couple of weeks has been wrong. You've been right. But it seems like some of the inflation numbers have been a bit more tepid. So is there a chance we have some kind of Goldilocks scenario or no? And obviously it could take time. We could have as you know, you said is the growth is okay, even maybe medium, and then inflation is softer down to 3.5, 4, which the markets would take as pretty close to a win. But as we've discussed, that's not a win, certainly not a victory. So, but they still could take months for that to play out. So, is that the scenario you kind of think we'll see?
Yeah, I mean, so I'm thinking that, in terms of the Fed, it's really the data that is going to force them to be much more aggressive. And you will need strong, overwhelming data. As you say, at the moment, the data shows that growth is picking up, which is, by the way, the opposite of what the FOMC predicted. Their soft landing scenario is based on growth falling below potential, so below 2% year on year in the second half of the year. And clearly, it's not happening. And in terms of inflation, there's no question that we are in a period where inflation shocks are not as strong as they were, say, in the spring. And I think it's because of two trends working in opposite direction. The first is supply chains improving. And so goods price inflation is slowing. And also, the war in Ukraine has produced a very weird supply shock in the sense that we have unusually large spreads between the price of different forms of energy. Like take oil, for instance. We didn't have the huge increase in oil prices, which I expected. Why? Because the Russians found ways to sell to third parties, which itself reflects the fact that the US is not as powerful an international actor than maybe 20 years ago. And then the Russians have been forced to cut prices to sell to these parties. So these are actually the sanctions, I think, have actually lowered oil prices so far. But then look at the price of gas. And what we have in Europe is clearly a full-fledged supply shocks. I mean, and the funny thing is nobody is really talking about it in the market. But if you read the newspaper, and I joke that half of my job is that, but you really hear stories about factories in the Netherlands, in Germany, even in Italy closing down, or businesses closing down because they can't get gas, they can't get the energy. So you have this supply shock, which is so far very localized, very European. And you have also a huge increase in commodity, in food prices at the consumer level.
Yes,
Not so much.
because at the futures level, they're actually most ag prices are back where they were in January, February. But I had one question about Europe is, so why even in Europe have the growth numbers been okay, where people were predicting like, oh, Europe is already in a deep recession. It could be in a depression, like 3 months ago, people were saying that. And it doesn't look like it so far.
Because European governments have not allowed energy prices to be passed through to consumers. So the hit to consumption is yet to come. I mean, look at the UK where you live. I hope you are ready for your winter bill to double? Or I mean, you have all these dire prediction, which are even worse in the continent, because the continent, especially countries like Germany, were more reliant on Russian gas than the UK.
Yeah.
So a big explanation is basically the government blocking the pass-through from markets to the consumer. And so consumption has kept going strong, but they can't do that forever. I mean, look at France. It decided to nationalize the electricity generating company, EDF, because they imposed losses on them, basically by preventing EDF from passing on the cost to their customers. EDF had to suffer massive losses, so the government decided to buy it. But remember, in Europe, they have this thing, this very weird thing called the European Commission, and they have fiscal constraints that we in America don't have. And so the extent to which the government will be able to block the pass-through through government subsidies is going to be limited by their fiscal mechanism. And so they will have to let the ultimate user of that energy eventually foot the bill. And that is going to be devastating, but it's more likely to be next year or next year.
Yeah. I think there's also, I mean, I'm not an energy specialist, but there's, my understanding, there's some kind of mix between short-term or spot kind of exposure to prices, and then longer-term contracts that have been locked in, and some of those contracts with prices are much higher. So things, that's one thing. Another, I think for France specifically, is my understanding is that they do send some of their electricity outside of to Germany, I'm sure, but maybe even the UK. So there's a few issues like that. But clearly, yes, if you look at the UK as an example, the pain seems like it's coming now. And I think that's partly why there's pressure on the pounds and stuff. So, okay, cool. And then kind of, the week ahead, I know in the US, it's, there's Labor Day, but like, the real fun stuff, markets really start after Labor Day. So maybe it's 1 week past next week, but what do you see next week? And outside of the data, are you looking for markets to react a certain way?
Sure. So the Fed still has to tell us whether they will do 50 or 75. And next week we have Powell and Brainard. So since this is the last week before the pre-meeting blackout, they are probably going to give us a hint, though the CPI, it's not, to be clear, they are not just looking at CPI and NFP. They want growth to slow. So they are going to look at a whole range of variables that basically are short-term proxy for GDP growth. But the CPI is a big one, and it will happen during the blackout. That said, as we were just discussing, we are in a period of relatively tame inflation because goods inflation is coming off, and services inflation has not yet fully taken off. So the likelihood of a nasty CPI surprise is probably smaller this month than saying in July. So this week should give us a fairly good idea of what they are going to do. I'm still thinking 75 because the one report we've had, the labor market report, which really gave a break to the Fed. You had higher than expected, but slower job growth. Wage growth slowed a little bit, the unemployment rate went up. It's just one data point, right? I can't.
Yeah, participation went up as well.
Yeah.
I feel like unless it's the numbers say very weak and a very weak CPI, they kind of have to do 75 after his big speech. Like the risk is almost, and I think the market's definitely not pricing this, but the risk is they do 75 and then maybe they move down to 25. But I think to do 50 now after this big speech, like, it's not like the numbers are terrible. They're just more tepid than some expectations, but the growth numbers are okay. So kind of agree with you in that sense.
Yeah, I mean, I hope our listeners will read my tongue-in-cheek note on Jackson Hole. But if they want to regain credibility, if they want to tighten financial conditions, they have to regain credibility. The risk if they go 50 is that financial conditions will ease, and yields will move back down. So we will see. We will find out this week, most likely. Otherwise, data-wise, it's going to be a quiet week. The most important data, I think, will be the services PMI, where the consensus is for the PMI to move sideways. So still remain around 55, which is a good number.
It's pretty high.
Yeah. So, and that's about it. We also have a trade balance, jobless claims, consumer credit inventories. Those are second order data. So I am hoping that we finally get a quiet week. But, I've been saying this all summer and I've been wrong all summer. Maybe a quick word about the elections, midterm elections, since we are getting close.
Sure.
So it's in 2 months. It's on November 8th. And things have changed quite a bit, actually. All the pollsters, whether they are, Republican or Democrat leaning, agree that things look a bit better for the Democrats, that based on current polls, they would retain the Senate. And it's not even clear that they would lose the House. It's certainly much less likely than a couple of months ago. And the reasons cited by the pollsters are interested. The Supreme Court ruling on Roe v. Wade apparently has played a big role in energizing centrist or democratic-leaning voters. Also, former President Trump polled relatively well. I mean, his candidate polled well in the primaries, so he won his candidates won quite a few primaries. He's also announced, or quasi-announced, that he was going to run in 2024, and centrist voters don't like that, so that's another reason why they don't like the candidates, especially. So that's another reason why the Democrats are doing better. And then, of course, gas prices going down certainly has put the American voters in a better mood, so less inclined to kick out the incumbents. So that's about it. But that's
it's interesting. Yeah.
It's important because if we have a split Congress, like if we have the Republicans holding one of the two chambers, there's going to be fiscal consolidation. And actually, one of the papers at Jackson Hole was making the point that to tame inflation, you might need a combination of fiscal and monetary consolidation. And I tend to agree with that.
Yep.
And so the Democrats keeping control of Congress is potentially going to make the task of the Fed more difficult.
If the Democrats keep the Senate but lose Congress, as long as they lose one of the two houses, it'll be hard to pass anything. That's kind of.
It will be hard to pass anything, but especially the budget.
Yeah.
Because, there is this weird procedure in the Senate called the filibuster.
So we'll do this whole cap thing again.
But they can only do reconciliation, which overcomes the filibuster, if they have a majority in both the House and the Senate. So if they lose either, they'll have to make a deal with the Republicans, and the deal will involve fiscal consolidation.
Yeah. I mean, the other thing also, I think if the Republicans get both, they'll try and do the same kind of thing where they'll go after Biden and, for impeachment or something like that. So I'm sure it's going to be, more volatile as well. So Okay, awesome. Anything else that?
No, I mean, I hope everybody has a very, very nice Labor Day weekend and hopefully an easy transition back to the real world next week.
Yes. I guess last thing I was going to ask, why is the strong dollar not having a bigger impact? Do you have any view on that?
Sure. I think it had a bigger impact, and that's why we had indicators of manufacturing, whether it's manufacturing production or the PMIs weaker in the first
Yeah.
half of the year. And then I guess people adapted and the dollar consolidated a little bit. So we are in this a period where businesses are kind of catching their breath after
Yeah. And maybe hedging and yeah.
yeah.
And also maybe just coming to the conclusion that even if it's a bit more expensive in the US, maybe it's safer for the medium long term than Europe or emerging countries for a variety of different issues. But for Europe, because of the concerns around kind of energy security, and
Yeah.
if you're, industrial company, it does make some sense. So.
Oh,
Yeah.
definitely. And also the fact that Europe is much more dependent on global demand, especially Chinese demand, than the US. I mean, the US is a more domestic driven. And in the sort of economic environment that we are in at the moment, it is an enormous advantage.
Yep. Okay, awesome. All right, well, thank you very much.
You.
Enjoy the rest of your weekend, and hope that all our kind of investors, clients are continuing to kind of enjoy these videos. And as we always say, we get some great comments. Yeah, any feedback, any thoughts and stuff we can improve would be awesome. So good luck, everyone.